Hello everyone. Welcome to EPK Capital. Here we work with individuals and companies and help them build wealth for generations. I am your host, Rutik, and today we are delving deeply into an engaging topic for NRIs. I assure you that this video will make your life much easier as a non-residential Indian. So stay connected. And as a bonus, I have also prepared an in-depth analysis. 7 costly traps in your Indian taxes. Guidance from an HNI advisor on how to avoid them. You can click on the link in the description to download it. Now let's get started. So, if you are a successful non-residential Indian, you are likely managing a global portfolio. You are focusing on big questions: returns, diversification, and growth. But in my over 20 years of experience, the biggest financial losses for NRIs do not come from bad investments. They come from small, pressure-free errors, significant structural mistakes in taxes and compliance that can cost you millions. These are not beginner mistakes. These are HNI level mistakes. Let's talk about the 3 biggest mistakes I see every day. First mistake: confidentiality bomb that you do not see. This first mistake is the most dangerous because it is invisible until it's too late. You probably think you know the rule of being an NRI. I'm safe as long as I stay in India for less than 182 days. For you, that rule has dangerously become outdated. The laws have changed, especially for high-income individuals. If your Indian source income, comprising rent, dividends, and interest, is more than 15 lakh rupees, which is approximately $18,000, then the 182-day threshold can be reduced to only 120 days. Think about it. You come to India for a family trip, stay for 4 months, and by mistake, your immigration status changes. But the real trap here is what I call the privacy bomb. As soon as your status changes from non-resident, you are legally required to file Schedule for foreign assets along with your Indian tax return. This means that you will have to disclose your entire global financial identity to Indian tax authorities. Your US brokerage accounts, your UK assets, your bank balances in Dubai or Singapore. Everything. If not disclosed, the Black Money Act applies, which involves severe penalties. A fine of 1 lakh rupees per year is just the beginning. This is a destructive and completely unknown loss to your financial privacy. Error number 2: contaminating your tax-free account. This second mistake occurs due to easy convenience, but its consequences are very significant. You have your 2 main Indian bank accounts, as you should. Your NRE account for your foreign salary and savings. The interest earned on this account is 100% tax-free in India. Your NRO account for your Indian income, such as rent from your property. This account is taxable. Now, mistake: one day, your tenant in India should pay rent. For convenience, you tell them, just deposit it into my NRE account. You have just made a significant error. This directly violates the Federation of Exchange Management Act, FEMA, regarding the income collection in Indian rupees, violating India's foreign exchange rules. You have tainted your NRE account. There's a financial disaster here. A tax officer can now legally argue that since the account is not compliant, its tax-exempt character is lost for this year. The $1 million in clean foreign currency in that account on which you earn tax-free interest, it can now be considered fully taxable. You just turned your tax-free shelter into a huge tax liability, just to save a bank transfer. Error number 3: cash flow killer when you sell. This third mistake is the most straightforward financial drain I see. You decide to sell your property in India. The mistake is to remain inactive. You allow the buyer to deduct default tax at source or TDS. Problem? The law requires the buyer to deduct tax on the entire sale value, about 20 to 21%, not just on your profit. Let's run HNI numbers. You sell a property for 10 crore rupees. After all your expenses, your actual taxable profit is probably 2 crore rupees. Your actual tax bill should be around 41 to 42 lakh rupees. But since you were inactive, the buyer deducts 20.8% from the entire 10 crore rupees. This amount of 2.08 crore rupees is stuck with the tax department. It is more than 1.6 crore rupees of your capital, which was given to the government as an interest-free loan. You will not see that money for 12 to 18 months, and only then when you file your return and claim your refund. This is going to hinder cash flow. The solution lies in activation. Before the sale, your CA Form 13 should be filed to obtain a certificate of reduced deduction. This certificate, based on your actual profit, legally instructs the buyer to deduct the correct, reduced tax amount. A bonus trap: 16-year time bomb. I need to add another one because I often see it with property. The buyer offers you 20% black money or cash. It's tempting. Don't do it. This is a ticking bomb for an NRI. What will you do with that cash? You cannot deposit it without flagging it. If you get caught, the penalties will be severe. Not only the highest tax rate, but also penalties that could be up to 300% of the tax. And the worst part? For NRIs, the tax department can reopen a case after 16 years. 10 years later, when you have forgotten about it, you may receive a notice that will turn your life upside down. HNI opportunity. I told you what not to do. I leave you with an advanced strategy that most HNIs are missing. It's about your mutual fund benefits. Everyone believes that you have to pay capital gains tax on Indian mutual funds. However, recent high-level tribunal rulings have opened up a powerful legal strategy. Here is the argument. In simple terms, most tax treaties, such as with the UAE, give India the right to tax profits from shares. But a mutual fund's unit is not legally a share. A mutual fund is a trust because it is not a share. It falls under a different residual concept in the treaty. This concept gives your country of residence the exclusive right to tax. And if you are a tax resident of a country like the UAE, what is your capital gains tax? 0. By obtaining your tax residence certificate, filling out Form 10F and adopting this now defensible legal position in your tax return, your final tax on Indian mutual fund gains could be 0%. This is the difference between average investing and true wealth management. It's not just about choosing those assets. It's about creating the right structure around them. Thank you for watching.